Hello everyone, welcome back to the channel. This is Fair Value Finder, and today we're taking a look at Ferrari, ticker RACE. We did look at this one previously a year ago, so I wanted to check back in. This was on the do not buy list because I felt like the stock was very overvalued at the time. We were coming up with a fair value of 227.5 and a market value of 291. Well, today we're coming up with a fair value of 230 and a market value of 405. So the market definitely disagreed with my assessment, and I want to take a look at what's improved. Why have they performed so incredibly well? We do see a lot of progress across the board, but I want to take a deeper look into this. So, like I said, right now we're coming up with a fair value of 229.22. Why is this only $2 higher than what we came up with a year ago? Yet the stock's up 20%. We came up with an annual return of 14%. So it outperformed estimate, even though it was already overvalued. Part of that is multiple compression. Last time we took a look at it, the PE ratio was averaging 53 because 2019 was a little extreme as well. And now it's averaging 46. We're using a 45. If we make this 53.5 like it was last year, then we can see how that impacts the price. To get a true apples to apples comparison, that brings it up to $250. So that is that's a 10% boost right there. But multiples have compressed a little bit. 50 is excessive. I mean, if people are willing to pay that much of a premium for a luxury company, then I would be buying LVMH like crazy because they're undervalued with a somewhat reasonable multiple. So that's one answer to the question. As we look across everything here, earnings yield 2.32. Last year was 2.39, so that is down a little bit. Cash flow yield was higher. Last year was about 12. This year was 14. Although the average did drop. They had a really good year in 2019. Dividend yield, significantly lower. The stock price is up. But the payout ratio is about the same. Last year it was 28.96. This year it's 28.78. Still not really what I consider a dividend stock, but it is a nice cherry on top for a good company. These are all great. ROE went up. ROI went up a little bit. ROA went up as well. So previously those were 36, 12, and 12. They did make a lot of progress on their debt, which is probably one of the best things here. It was 1.99 debt to equity last year, and now it's 1.63. And that is something that I pointed out. We don't like a debt to equity over 1. This last year, their assets grew by 5.5%. Liabilities only grew by 2.3. Last time we looked at it, assets were up 11. Liabilities were up 7. So they have definitely slowed down on both of those. Margins still look great. Gross and net. Actually, last year, net margins were only 18%. This year, they're 21. And then the excessive PE ratios. So the red flags here, high debt, somewhat reasonable for the business that they're in. Cars are not cheap to build. Takes a lot of machinery. You might be sitting on some inventory for a while. But these valuation multiples are crazy. Currently trading at a PE of about 50. A PEG of 4.6. If you were to get into this at the fair value, you're looking at a PE of 26. Elevated, but not insane. And a price to earnings growth of 2.42. Still a little high. So earnings are not a massive driver here. So what is it? Thesis as usual. I'll go through what we had last year. Revenue growth 15%. Analysts were projecting 22% that year, 15% the following. At this point, they're projecting 11 over the next year and 9 the following. So that's definitely come down quite a bit. 9.5 in between those. Definitely a pullback from what we saw last time, though. Share count 0.75. We're seeing really high. We're seeing almost 1% buybacks out of them. which is really good to see. Last time we saw 0.6, 0.76, and had a thesis of 0.6. So that is something that improved quite a bit, and that's going to help across the board. They bought back more shares than we were expecting. That's going to help the valuation quite a bit. Cash flows, last time we looked, we didn't even really consider cash flows in the growth. We've come a long way since then. If their revenues are growing 9.5%, cash flow growth of 9% gives them a cash flow yield of 13.9 in 5 years, which is close to what they have right now. It could honestly be lower. Their average is around 11%, but we'll see what that gives us for now. Asset growth slowing down, 3% there, 1% on the liabilities. Dividend growth of 10%. They're growing it very quickly. It's only 10 when you see that 17 and that 24 because this is a compounding rate. So if this gets too big, they're early on in their dividends, but it grows quickly. At some point, they'll start slowing down, and it'll look excessive. But if this is true, in 5 years, you're looking at $3.52 for your dividend, which is almost 1% yield on the current price. And then margins, nothing too crazy, pretty flat, maybe up a little bit over time. All of that gives us returns of 14.2%. And then once you factor in the dividend, 14.72. So up a little bit over last year. I think that's mostly driven by the strong cash flows and the share count. And now some simple math. If your current value is $230, you're growing at 14.72% per year. In 3 years, you're worth $342, which is 14% lower than the current value. And in 5 years, you're at $516, 6% above the current value. So this thing is trading at massive multiples. It's trading at a valuation somewhere 4 to 5 years out, which means 4 to 5 years out, you could be looking at a valuation. If they can sustain growth 4 to 5 years out, you could be looking at a valuation somewhere in the realm of $700, in which case it's completely reasonable at today's price. You would be up significantly, definitely outperforming the market. So while we're on that topic, let's take a quick look at the pricing trends and see balance sheet very flat down here, just gradual increases, $57 of value coming off that. Cash flows leveled out in 2021, just gradually going up as well. Looks like about $200 of value off that. The actual fair value of the stock right here in between the fundamentals of the balance sheet and the cash flows, and then the actual performance of the stock and its earnings. We can see right here the actual share price for the stock. 2022 was a great year to buy, and it has just been off to the races since then. Earnings are on a nice, very strong growth trend. Actually, if you're buying this strictly off its earnings, $404 is the valuation at its typical multiple for next year's earnings. So that might be why the stock is up so much. People are buying it strictly off the earnings and the cash flows. If you're ignoring the rest of the fundamentals and buying strictly off those, we're looking at, let's say, somewhere between $380 and $400. So $390 would be the ideal price to be getting into this, which it's not too far off from. But once you look at a holistic picture, there's more to the business than just that. So this is definitely an earnings or this is definitely a growth stock. Strong revenue growth, strong earnings. Still not exactly what I'm looking for a stock. I'll watch for a pullback. If this thing pulls back to somewhere around the $300 level, I'll probably buy into it. It's one of those with how quickly it rose. If it starts falling, I wouldn't be surprised if it fell quickly too. So I'll definitely keep an eye on it. Definitely not something I'm going to be buying. I'm not going to be shorting. I'm just going to be watching from the sideline until I see what I like off of it. So I want to thank you guys for watching. Please like and enjoy the video. Comment what other stocks we should take a look at, and subscribe so you can stay updated with everything. And I'll catch you next time.